Disclaimer.
If silver were just another metal, this wouldn't be happening. But today, silver sits at the intersection of monetary optics, industrial necessity, and geopolitical signaling, and that's why it's caught in a policy crossfire. On one side, U.S. policymakers need silver to stay calm. A rising silver price sends uncomfortable signals. Inflation isn't contained. Paper markets are losing credibility. Physical shortages are real. On the other side, the U.S. economy cannot function without silver. AI data centers, power grids, defense systems, renewable energy infrastructure. These two realities are now in direct conflict. You can suppress a price. You cannot suppress a material requirement. And when policy goals collide, governments don't issue press releases. They go silent. That silence is what matters. Over the past year, silver has behaved differently from every other asset. Demand is rising. Industrial consumption is accelerating. Encouragement to mine more is absent. Access is tightening. Yet policy language remains deliberately vague. This is not indecision. This is crossfire. Silver is being pulled in opposite directions. Downward pressure to protect confidence, upward pressure from physical reality. And when assets get trapped like this, they don't drift sideways forever. They snap. The most dangerous phase in any market is not the crash. It's the period when price is managed, but reality isn't. That's where silver is right now. Before we talk about outcomes, we need to understand why silver matters so much to policymakers in the first place, and why neutrality is no longer an option. Silver did not become important overnight. It became dangerous. From a policy perspective, an asset becomes a target the moment it starts interfering with multiple objectives at once. That is exactly what silver is doing now. For decades, silver sat outside the policy target zone. It was volatile, yes, but irrelevant. Its price could rise or fall without threatening monetary credibility, industrial continuity, or geopolitical signaling. That changed the moment silver became embedded in systems the U.S. cannot allow to fail. AI infrastructure depends on silver's conductivity. Energy grids depend on silver's reliability. Defense systems depend on silver's performance tolerance. Once silver became unavoidable, it entered the policy target framework, even if no one ever used that word publicly. This is how policy targeting actually works. Governments don't say, "We are targeting silver." They say things like supply chain resilience, strategic materials, critical inputs, national security priorities. But behind closed doors, those phrases translate into target lists, and silver is now on that list. Here's the problem. Silver sends signals policymakers do not like. A rising silver price historically signals monetary instability, currency dilution, loss of confidence in paper systems. Those are not abstract signals. They directly conflict with inflation management narratives and financial stability messaging. At the same time, suppressing silver too aggressively creates shortages, and shortages threaten the very systems policymakers are trying to protect. So silver becomes a target in two opposite ways. Targeted for control, to keep the signal muted. Targeted for access, to keep industry functioning. That is the definition of a policy crossfire. This is why silver policy looks contradictory from the outside. You see, paper markets flooded, physical markets tightening. No urgency in mining incentives. Silence instead of clarity. That is not confusion. That is targeted ambiguity. Ambiguity buys time. Time allows systems to adjust quietly. But ambiguity cannot override physics forever. Silver is being pulled into a narrow target corridor. Too high, bad signal. Too low, bad supply. And when policymakers try to hold an asset inside a target corridor that ignores reality, pressure builds invisibly. This is the stage where most observers get it wrong. They think nothing is happening because there is no announcement. In reality, this is the phase where targeting begins. Silver has crossed from market asset to managed variable. And managed variables always break eventually, not because of speculation, but because reality refuses to stay inside targets. Next, we need to look at who benefits from keeping silver inside this target zone and who absorbs the cost when it doesn't hold. Every time an asset becomes a policy target, two groups emerge. Those who set the target and those who pay to keep it there. Silver is no exception. The target itself is not written down in a document you can read. It exists implicitly, inside risk models, procurement planning, and monetary optics. On one side of the target are institutions tasked with price stability and confidence management. They cannot allow silver to spike uncontrollably because silver has a long history as a confidence indicator. When silver rises too fast, it tells the public something policymakers don't want said out loud, that money is being diluted faster than advertised. On the other side are institutions tasked with keeping the real economy functioning. These entities don't care about charts. They care about inputs arriving on time. For them, silver is not a trade, it's a requirement. This creates a narrow target zone. Inside the zone, everything looks calm. Outside the zone, problems become visible. To keep silver inside that zone, pressure has to be applied somewhere. and that pressure does not fall evenly. The groups that control the target have tools: paper markets, regulatory discretion, liquidity access, narrative control. They can absorb volatility and delay consequences. The groups that pay for the target do not have those tools. They are manufacturers facing rising premiums, smaller buyers pushed out of contracts, end users forced to accept delays. Anyone who needs physical silver, not financial exposure. This is why you see a growing disconnect. The target is enforced in paper. The cost is paid in the physical world. This is not accidental. Targeting always works this way because paper systems are easier to control than physical systems. You can add liquidity to paper markets instantly. You cannot conjure silver out of the ground on demand. As long as physical shortages remain tolerable, the target holds. But here's the problem. Every time silver demand increases, from AI, energy, or defense, the cost of maintaining the target rises. More pressure is required, more distortions are introduced, and distortions compound. This is the hidden cost of targeting silver. The public sees a stable price. The system absorbs growing stress. Eventually, someone refuses to pay that cost anymore. That is when targets fail. Not because policymakers lose control, but because control becomes more expensive than letting reality show. Next, we need to examine why the United States cannot simply let silver rise the way it might want to, and what that reveals about deeper policy constraints. Once an asset becomes a policy target, it stops behaving like a normal market. Silver is now in that phase. The intention behind targeting silver is simple: keep price signals contained while supply chains adjust. But targeting creates feedback loops, and those loops tighten the trap over time. Here's how it works. When silver is held inside a target zone, price no longer reflects reality. That distorts behavior across the entire system. Industrial buyers notice first. They don't trust the target price. They look at delivery times, inventory levels, and supplier behavior. When those indicators worsen, buyers stop treating silver as a just-in-time input and start treating it as a must-secure resource. That behavior accelerates demand. The more demand accelerates, the more pressure builds beneath the target. Policymakers respond the only way they can, by reinforcing the target: more liquidity, more paper supply, more narrative control. This keeps the price calm, but it deepens the physical imbalance. That imbalance then feeds back into buyer psychology. Every buyer knows the target price is artificial. That knowledge creates urgency. Urgency creates hoarding. Hoarding tightens supply further. This is the trap. The target creates the very behavior that makes the target harder to maintain. At the same time, producers react differently. Mining and refining do not respond quickly to price targets. Silver supply cannot be ramped up on demand. Most production is tied to other metals. Investment decisions take years. When producers see silver held inside a narrow target zone while costs rise, they hesitate to expand capacity. Why commit capital when price discovery is constrained? That hesitation caps future supply. Now the trap tightens from both sides. Demand accelerates, supply stalls, all while the target remains officially stable. This is why policy targeting eventually becomes unsustainable. Each intervention raises the cost of the next intervention. Each month of suppression increases the imbalance that must eventually be resolved. History shows that targets rarely fail gradually. They fail suddenly, when the cost of holding the target exceeds the cost of letting it break. Silver is approaching that inflection point, not because of speculation, not because of retail demand, but because structural forces are pushing harder than policy tools can absorb. Next, we need to look at why this crossfire is uniquely dangerous for silver compared to other commodities, and why the U.S. has fewer escape routes than it appears. When a policy target starts to fail, governments usually look for an exit. They loosen controls, they redefine metrics, they shift attention elsewhere. Silver offers no such escape. Most commodities have multiple release valves. Oil can be released from reserves. Grain can be substituted. Industrial metals can sometimes be redesigned out of systems. Silver does not offer that flexibility. From a policy standpoint, silver is trapped between non-negotiable requirements and non-substitutable physics. First, silver cannot be replaced in the systems that now depend on it. Conductivity limits, thermal tolerance, and reliability are not policy choices. They are physical laws. Once silver became embedded in AI infrastructure, energy systems, and defense hardware, it stopped being discretionary. That means policymakers cannot pause demand without pausing critical systems. Second, silver supply cannot be scaled in response to price signals. Because most silver is produced as a byproduct, higher prices do not automatically result in higher output. You cannot target supply upward the way you target demand downward. This is why silver targeting is uniquely dangerous. There is no symmetrical response available. Policymakers cannot quickly increase supply, easily substitute materials, reduce demand without consequences. That leaves only one lever: management of perception and flow, but perception management has limits. Once industrial buyers begin securing supply outside traditional channels, policy loses visibility. When long-term contracts replace spot markets, price becomes less informative. When physical inventories move off exchange, the ability to manage the target weakens. This is the silent erosion phase. It looks stable on the surface, but control is slipping underneath. Silver is also politically sensitive in a way most commodities are not. Historically, silver has been associated with monetary stress, populist movements, and loss of trust in institutions, allowing silver to visibly break its target risks, reigniting those narratives. So policymakers are boxed in. They cannot let silver rise freely. They cannot suppress it indefinitely. And they cannot redesign systems away from it. This is what makes the policy crossfire dangerous. Every option carries risk. Every delay increases pressure. At this stage, policy is not about winning. It's about choosing the least destabilizing path. And history suggests that when governments reach this point, they prefer managed release over uncontrolled rupture. The question is not whether the target eventually breaks. The question is how and when it is allowed to move. Next, we need to examine what happens when managed targets finally give way, and why the release is rarely smooth. When a policy target finally breaks, it does not break quietly. Targets fail in phases, and silver is approaching the most dangerous one. The first phase is denial. Price still appears contained. Official narratives remain calm. Policymakers insist the system is functioning as designed. This phase can last longer than expected because paper mechanisms can absorb pressure for a time. The second phase is strain. Physical markets begin to decouple. Premiums widen. Delivery delays become normalized. Contracts shift from spot pricing to availability-based pricing. This is the phase where insiders know the target is weakening, but the public does not. Silver is already deep in this phase. The third phase is loss of marginal control. This is the moment that matters. Control does not disappear all at once. It disappears at the margin, when one more unit of pressure cannot be absorbed without visible consequences. A large buyer refuses to accept paper settlement. A critical supplier locks in long-term contracts. An exchange quietly adjusts rules to protect itself. At that point, the target is still officially intact, but functionally broken. This is where volatility explodes, not because demand suddenly appears. Demand was already there. Not because supply suddenly vanishes. Supply was already constrained. Volatility appears because price is forced to reconnect with reality. Once silver exits the target corridor, it does not drift higher gently. It reprices violently, searching for a level where demand slows, hoarding stops, supply becomes available. That level is almost always higher than expected. Policymakers know this. That's why they delay release as long as possible, but delay has a cost. The longer silver is held inside an artificial target zone, the more energy builds behind it. Think of it like a compressed spring. A slow release requires room to move. A constrained system releases explosively. This is why historical price targets rarely unwind smoothly. They end in gaps, jumps, and regime changes. The moment silver breaks its target, several things happen at once. Paper markets lose dominance. Physical access becomes the primary metric. Contracts are rewritten. Confidence narratives shift. This is the moment most observers mistake cause for effect. They blame speculation. They blame panic. In reality, the break is the result of long-term targeting colliding with physical limits. Silver does not break because people suddenly wake up. It breaks because targets eventually lose the ability to contain reality. Next, we need to bring this together and explain what this means for everyone watching from the outside, and why this moment is not about price targets, but about access and power. At this point, it's important to step back, because once silver becomes a policy target, the question most people ask is the wrong one. They ask, where's the price going? That question assumes price discovery is still free. In a targeted system, price becomes a managed outcome, not a reflection of reality. The correct question becomes, who gets access when supply tightens? That is the real divide. When silver is treated as neutral, access is equal. When silver is targeted, access becomes hierarchical. Priority flows to strategic industries, long-term contracts, entities aligned with policy objectives. Everyone else is pushed to the margin. This is why the most important signals are no longer on charts. They are in delivery times, premiums, contract terms, inventory behavior, silence from institutions that used to speak loudly. When access matters more than price, markets fragment. Paper markets continue to quote numbers. Physical markets operate on availability. That gap is not temporary, it is structural. This is also why silver behaves differently from other assets during periods of stress. Gold can be hoarded quietly, oil can be rationed, semiconductors can be allocated. Silver sits in between all of them. It is small enough to be constrained, critical enough to be targeted, and symbolic enough to send uncomfortable signals when it moves. That combination makes silver uniquely sensitive to policy crossfire. From the outside, it may look like nothing is happening. From inside the system, behavior has already changed. And once behavior changes, outcomes follow. This is not a call to action. It is a call to awareness. Because the moment silver stops being neutral, the system stops treating everyone equally. Targets are set, flows are managed, access is prioritized. And history shows that when access replaces price as the governing rule, transitions are rarely smooth. The most dangerous phase is not the break itself, it's the calm before it, when the target still appears intact, but the cost of holding it is quietly rising. Silver is in that phase now. The crossfire isn't loud, it isn't dramatic, but it is real. And when policy targets collide with physical reality, reality always wins, eventually. From the outside, the solution looks simple. If silver demand is rising and supply is tight, why not let the price rise naturally? Because for US policymakers, silver is not just a commodity price. It is a signal. And signals are dangerous when you're trying to maintain confidence. Silver has always occupied a unique position in the monetary system. It is not official money, but it is not just an industrial metal either. When silver rises sharply, it sends an unmistakable message that paper promises are being questioned. That makes silver a targeted signal. Allowing silver to rise freely would do three things policymakers cannot afford all at once. First, it would undermine inflation narratives. A rising silver price contradicts claims that inflation is under control. It tells the public that purchasing power erosion is real and ongoing, regardless of official metrics. Second, it would expose paper market fragility. Silver is one of the few assets where the gap between paper exposure and physical availability is structurally large. Letting silver rise aggressively risks revealing how thin that physical backing really is. Third, it would trigger political consequences. A sharp rise in silver is often followed by public scrutiny, hearings, and pressure to do something. Policymakers prefer silence to spotlight. So silver becomes a price target, not because anyone wants to cap it forever, but because uncontrolled movement creates cascading problems. At the same time, suppressing silver too hard creates a different set of risks. Industrial users don't respond to price targets. They respond to availability. When price is artificially restrained, demand doesn't disappear. It accelerates. Buyers rush to secure supply before access worsens. This creates a paradox. The more silver is targeted for price stability, the more physical stress builds underneath. This is why you see contradictory behavior. Price appears stable. Physical premiums rise. Delivery times stretch. Inventory thins. The target holds on the surface, but the foundation weakens. From a policy standpoint, this is a temporary solution. It buys time. It avoids headlines. It allows systems to adjust quietly. But time is not infinite. Every month, silver remains inside an artificial target zone while demand rises. The eventual adjustment becomes more violent. Policymakers know this. That's why they are not trying to solve silver. They are trying to manage the transition, delaying the moment when silver escapes the target altogether. The danger isn't that silver rises. The danger is that it rises too fast, revealing that the target was never sustainable. Next, we need to look at how this targeting creates feedback loops and why those loops make eventual release harder to control.
Disclaimer.